Welcome to the Deep Dive, your express route to understanding the most complex and compelling topics. Today we're plunging into the tumultuous high-stakes world of cryptocurrencies. Just consider this. We're talking about a market that has surged past, $2 trillion in market cap. Yet it's infamous for its extreme, often bewildering volatility. How do you even begin to find clarity, let alone predict movements, in something so inherently unpredictable? Okay, let's try to unpack this. Our mission for this deep dive is to explore the groundbreaking role of machine learning, that's ML, in predicting cryptocurrency prices. Think of this as your essential guide, kind of cutting through the noise to deliver the most important insights. We're drawing from a wealth of recent academic studies, primarily those published between, say, 2020 and 2025. We'll uncover the most effective ML techniques, their proven performance, and, well, the fascinating future they're shaping for digital finance. Get ready for some genuine aha moments and, hopefully, some truly actionable insights. So let's quickly set the stage.
Cryptocurrencies really exploded into global consciousness with Bitcoin's arrival back in 2008. Since then, giants like Ethereum and Litecoin have emerged, spearheading this whole decentralized, incredibly fast, and often anonymous financial revolution. It's a market driven by innovation and, as you mentioned, notorious for its dramatic swings.
Yeah, what's truly fascinating here is just how fundamentally challenging this market is for, traditional analysis. That extreme volatility you touched on isn't just random noise. It's a whirlwind of speculation, shifting government regulations, lightning-fast tech advancements, and even geopolitical events playing a role. And this is precisely where conventional statistical methods, like the widely known RMI models, they just fall short. They operate on these assumptions of linearity and stationary data, meaning data that's sort of consistent over time. But crypto's patterns, they're anything but linear or static. They're complex, nonlinear, often chaotic. It's like trying to predict the path of a fly in a hurricane with just a ruler and a steady hand. Doesn't really work.
That's a perfect analogy. Really hits home. So given these inherent struggles of the old methods, what fundamental shifts does machine learning bring? What makes it so much more suitable for tackling crypto's complexity?
Well, it's a complete paradigm shift, really. Machine learning, as a powerful branch of AI, it lets systems learn these incredibly intricate patterns directly from vast data sets. And crucially, without needing explicit, rigid programming telling them exactly what to look for. This capability makes it uniquely suited for highly volatile, nonlinear time series data, which is exactly what cryptocurrency prices are. Academic evidence consistently demonstrates that ML techniques don't just slightly improve prediction accuracy compared to those traditional models. They fundamentally change what's possible. It's crucial to remember, though, that it doesn't magically eliminate all market uncertainty. Nothing can, probably, but it does equip us with far more sophisticated tools to navigate it.
Right, better tools for a very tricky job. And so the overall goal of the research we're exploring today is really to meticulously examine how ML genuinely enhances crypto price prediction. It achieves this by processing that incredibly complex, multifaceted data you mentioned.
Yeah, all those different inputs.
And then distilling it into truly actionable insights, offering a much-needed, scientific understanding of this incredibly dynamic and often bewildering market. Now that we understand why ML is so vital here, I'm genuinely curious. Given the challenges, what are the specific ML models that researchers are finding most effective? Which ones are the real workhorses in actually predicting these crypto movements?
Okay, that's where it gets exciting. There are indeed a few key players showing up repeatedly in the research. First, we have recurrent neural networks, or RNNs, and maybe more importantly, their advanced variants like LSTMs, that's long short-term memory, and GRUs, gated recurrent units. These models are exceptionally good with sequential data. Think of them as having a kind of memory. This lets them consider past data points in a sequence, which is absolutely essential for understanding trends over time in financial markets. For instance, one study comparing various deep learning models found LSTMs actually outperformed the others. They were achieving accuracies between 52.9% and 54.1% in daily predictions across 100 different cryptocurrencies. Now, that might sound like only a small edge, just over half the time, right? But in high-frequency trading or even just active portfolio management, correctly predicting the market's direction even slightly more often than not, well, that's incredibly powerful. It can lead to substantial gains over time.
That small edge, compounded daily or hourly. Yeah, that certainly makes a huge difference in the long run. What about other ways to measure success, other metrics besides just simple accuracy?
Absolutely, good point. Accuracy isn't everything. Another analysis specifically looked at Bitcoin and showed LSTMs reducing the mean squared error, or MSE. They cut it down by a significant 20–30% compared to traditional RIMA models. For anyone unfamiliar, MSE is a common metric for prediction error. A lower number means a more accurate prediction. So a 20–30% reduction. That's a considerable leap forward in precision, telling you your predictions are closer to the real outcomes. And for those interested in risk-adjusted returns, which is really key in volatile markets, LSTMs even achieved an impressive Sharpe ratio of 3.23 for both Bitcoin and Ethereum in one study. To put that into perspective, a Sharpe ratio above 1 is generally considered good, and anything above 2 is usually seen as excellent. So a 3.23 ratio signifies remarkably strong returns for the level of risk taken. That's quite something in these markets.
Wow, okay, those are definitely compelling numbers. A Sharpe ratio like that is hard to ignore. But is there a downside? Or maybe a particular type of crypto data where LSTMs might struggle a bit and where other models maybe pick up the slack?
That's a great question, because you're right, no single model is a silver bullet. They all have strengths and weaknesses. While LSTMs are fantastic for sequences and memory, sometimes the challenge is extracting very specific, maybe subtle features from noisy data. And that's where convolutional neural networks, or CNNs, come in. Now, you might often hear about CNNs in the context of image processing, recognizing pictures and things, but they're incredibly powerful at identifying hierarchical patterns and extracting robust features from raw, complex data, too. This makes them remarkably effective for financial time series, even when the data is messy or has a lot of noise. In fact, a systematic review reported that CNNs achieved an impressive 91% precision on multi-cryptocurrency datasets.
91% precision, that sounds incredibly high.
It does, and precision focuses on how many of the positive predictions were actually correct. It highlights their ability to perform consistently well, even in the most volatile market conditions, while keeping that prediction error, the MSE, low.
Okay, so we've got models with memory like LSTMs and models like CNNs that excel at feature extraction from noise. This seems logical.
Yeah.
What happens when you combine their strengths or combine multiple models?
Precisely. That leads us right into ensembles and boosting methods. This includes popular models like XGBoost, late GBM, random forest, and gradient boosting. The core idea here is actually quite elegant. Instead of relying on just one single model's prediction, you combine the predictions of multiple individual models, maybe even different types of models. This wisdom of the crowd approach, if you will, typically leads to significantly improved overall accuracy and robustness. Why? Because the weaknesses of one model are often compensated for by the strengths of others in the ensemble. For instance, one research paper on price forecasting showed that XGBoost could explain a statistically significant 4.855% of the variance, that's the R-squared value, across a massive data set of 3,703 cryptocurrencies.
Okay, 4.855% R-squared. That might sound small to some listeners.
It might, in isolation. But in a market as chaotic and seemingly random as crypto, being able to explain any consistent portion of the price variance is actually a notable achievement. And importantly, this predictive power translated into generating average daily returns of 7.1% in their simulated trading portfolios based on those XGBoost predictions.
Wow, okay, 7.1% daily return in simulation is huge.
It is. And even more striking, some studies found ensemble methods achieving Sharpe ratios ranging from 80% to 91%, or 0.8 to 0.91, depending on how you scale it for Bitcoin and Litecoin. These models truly leverage a kind of collective intelligence, making them incredibly effective tools in such a dynamic environment.
So we've talked about how these models work, the theory, and some pretty impressive numbers they can achieve in research settings. But for you, our listener, the real question probably is, okay, what does this all mean for me in a practical sense? How does all this complex ML stuff translate into real-world trading strategies or just more informed decision-making if you're involved in crypto?
Yeah, this is really where the theoretical meets the practical, isn't it? Where the rubber meets the road. Machine learning doesn't just give us fancy academic numbers. It directly underpins sophisticated data-driven trading strategies. For example, one study specifically looked at crypto trading with ML under changing market conditions. They found that certain ensemble models generated Sharpe ratios of 80.17% or 0.8017 for Ethereum trading. Now, that's not just a good number on paper. It signifies a massive potential improvement in risk-adjusted returns compared to simple strategies like just buying and holding. And buy and hold is often the baseline people compare against. So it suggests potentially much higher returns for the amount of risk you're taking on.
A huge difference indeed. It really changes the game, potentially. And it begs the question, how much data is enough? Or is there a point of diminishing returns when you start incorporating lots of different data sources? Because I imagine bringing in more kinds of data, not just price, only makes these models smarter, right?
You're hitting on a really crucial point. Multi-source data integration. It's a big focus in the research now. Generally, the more relevant data you can feed these models, the better they perform. Although, yes, you could eventually introduce too much noise if the data isn't useful. But research vividly demonstrates the benefits. For example, integrating social media sentiment, like analyzing the general mood or specific mentions on platforms like Twitter or Reddit. This has been shown to improve prediction accuracy by a notable 10–15% in some cases.
Interesting. So market mood actually matters.
It definitely seems to. It shows that market sentiment, which is often missed if you only look at pure price and volume data, is a powerful indicator. Furthermore, these multivariate approaches, meaning models that incorporate a wider range of factors, things like traditional market indices like the S&P 500, gold prices, oil prices, even network transaction volumes on the blockchain. These models consistently outperform simpler univariate models that only look at the crypto's own past price, especially when you're trying to predict multiple steps or days into the future. It's all about building a richer, more contextualized picture of the market environment. And this actually raises another important question. How does ML perform when markets get really, really tough, like, say, during a crash or a bear market? We saw unprecedented market shifts during and after the COVID-19 pandemic, for instance. Studies conducted specifically looking at those challenging periods highlighted ML's remarkable resilience. Even in bear markets, certain models were achieving accuracies of 57–59% on subsets of data where the model expressed high confidence in its prediction.
So even when things are going down, they can still offer some guidance.
Exactly. It suggests that ML can indeed help investors navigate severe downturns and periods of high stress, offering a valuable edge when human intuition might be clouded by fear or panic.
So it's clearly not just about predicting prices in isolation anymore. It sounds like the true frontier isn't just refining the prediction models themselves, but also how ML integrates with other cutting-edge technologies, like creating entirely new capabilities.
Exactly right. The synergy is key. For instance, ML is being combined with blockchain technology itself for sophisticated anomaly detection within the market. By using statistical measures like z-scores, which basically identify how unusual or unexpected a data point is compared to the average, ML can help flag potentially suspicious trading activity, market manipulation attempts, or even technical glitches, thereby helping maintain market integrity and security. And on the prediction front, we're also seeing the emergence of even more advanced deep learning architectures, models like Transformer, which revolutionized natural language processing, and even newer ones like Hellformer. These are showing promise for improved daily price prediction by leveraging even more complex ways of understanding temporal relationships and patterns within the data. They use concepts like self-attention. It's really pushing the boundaries of what's possible in time series forecasting.
Okay, while the promise of ML in crypto prediction is clearly incredible, we have to be realistic. It's not a magic bullet, as you said, nor does it guarantee perfection. Far from it. So what are some of the biggest hurdles, the real challenges that are still preventing perfect, or even near perfect, ML-driven crypto prediction? Why isn't everyone using this already a crypto billionaire?
Yes, the million-dollar question, or maybe the $2 trillion question. You're absolutely right to bring this up. There are significant, persistent challenges that the academic research continually grapples with. The first, and perhaps the most fundamental, is volatility and non-stationarity. Crypto prices exhibit these extreme, often abrupt fluctuations. The underlying statistical properties of the data, the mean, the variance, they're constantly changing. This non-stationarity, this constant change makes it really hard for models. It can easily lead to overfitting.
Overfitting, that's where the model learns the past data too well, right?
Yeah, exactly. It fits the noise and specific quirks of the training data, but then it fails miserably when it sees new, unseen data. This makes real-world predictions unreliable, and it often causes the model's potential errors to be significantly underestimated during testing. Second big challenge, data quality and availability. ML models are fundamentally data-driven. They're only as good as the data they're trained on. And often, we're dependent on historical price data that can be noisy, contain errors, or have gaps. Exchanges go down, APIs change. There's also often a lack of cleanly labeled data for specific events or for few-shot learning scenarios where you only have a very small number of examples of something you want the model to learn. This really underscores the crucial need for robust feature engineering.
Feature engineering, that's like selecting the right data and transforming it so the model can understand it better.
Precisely. It's the art and science of selecting, cleaning, and transforming raw data into features that best represent the underlying problem to the learning algorithm. Without good features, even the most sophisticated model will struggle. Third, there's this ongoing, almost philosophical debate around market efficiency and arbitrage limits. Now, ML techniques, especially when using diverse data, certainly seem to challenge the idea of weak-form market efficiency.
Which is the theory that says you can't predict future prices just by looking at past prices.
Correct. ML suggests maybe you can, to some extent. However, even if a model identifies a potential profitable trade, practical factors kick in. Things like transaction costs, exchange fees, network fees, slippage, that's the difference between the price you expected and the price you actually got filled at. And market liquidity, can you actually buy or sell the amount you want without moving the price against you? All these things can significantly reduce or even eliminate the actual profitability of any predicted arbitrage opportunity. So seeing an opportunity on a chart and actually capturing that profit in the real world are two different things. Fourth, and this is critically important, the ethical and regulatory issues. The immense power of these predictive models, well, it could unfortunately be misused. You can imagine scenarios where they could potentially facilitate sophisticated forms of market manipulation, maybe help orchestrate pump and dump or Ponzi schemes, or even be used for complex tax evasion strategies. This really highlights an urgent need for robust cybersecurity frameworks around these systems and also for clear, evolving ethical guidelines. We need rules of the road to ensure the responsible development and deployment of these powerful technologies. It's about making sure these tools are used for good, not harm. And finally, number 5, we face sheer computational complexity. Deep learning models, especially the really advanced ones like transformers or large ensembles, are incredibly resource intensive. They need a lot of processing power and memory. Training them takes time and energy. Validating them properly, especially when you start integrating diverse, multi-source data from various markets, social platforms, news feeds, it adds substantial complexity. It requires significant computational infrastructure, powerful GPUs, cloud resources, which might be more than an individual trader or even a small investment firm can easily access or afford.
That's a really sobering list of challenges. Volatility, data issues, market realities, ethics, and just the sheer cost and complexity. It really underscores that this isn't simple. It sounds like addressing these challenges requires continuous innovation across the board, whether that's through even more advanced ensemble techniques to handle noise, better feature engineering to extract clearer signals, maybe exploring alternative metrics beyond just accuracy for more robust predictions. It's truly a field that's constantly evolving, with new solutions and new problems emerging all the time. So let's try to bring all these threads together now. For you, our curious listener, the core message remains clear, I think. Machine learning is playing a truly pivotal and likely growing role in cryptocurrency prediction. It offers tools that are significantly superior to traditional methods for handling the market's inherent wild volatility and its deep complexity. We've explored today how, dozens of academic studies, we mentioned over 40, confirm that models like LSTM, CNNs, and various ensemble methods like XGBoost,
They're achieving prediction accuracies well over 50% in many tests, reducing errors compared to older methods and generating positive risk-adjusted trading returns, at least in simulated environments. And this ultimately translates to the potential for more informed decisions and significantly better risk mitigation for anyone operating in this very challenging space. But it's really important to reiterate, while ML definitely strengthens market analysis and promotes innovation, it doesn't guarantee perfect predictions. It's not a crystal ball. The chaotic, almost random-seeming nature of the crypto market at times, combined with those significant ethical, technical, and regulatory hurdles we just discussed. It all means there will likely always be an element of uncertainty, of unpredictability. It's really about gaining an edge, improving your odds, not achieving omniscience. But let me leave you with a final thought to consider, something to mull over.
If machine learning continues to advance in its ability to predict these complex financial movements, and we get better and better at integrating diverse data sources, at feature engineering, and also at addressing the very real ethical and computational considerations, how might this fundamentally reshape our trust and interaction, not just with crypto, but with all financial markets? Will algorithmic insights eventually become the primary drivers of most financial decision-making? And if so, what new questions will that raise about the enduring role, if any, of human intuition, human judgment, and ultimately human control in the world of finance?